welcome to slide pack 13 of the financial modeling program. What we plan to talk about today here is projecting cash flows for the cash flow statement. And as I've mentioned quite a few times in the past, essentially your cash flow statement derives largely from your income statement projections and to some extent from your balance sheet projections. So with that, let me move into my Excel sheet and let me show you how we've projected cash flows for TPCC, which is the example we had also used earlier. So now here, if I go to the cash flow statement, what you'll see is that I have some historical data for December of 2010, essentially for the fiscal year that ends on the 31st of December 2010. And as you can see from the formulas, what I am doing is projecting out the cash flow for December 2011 through 2014. Now, the first thing that, if you recall, on the statement of cash flows, the very first line is typically some form of income, and what we've taken in the case of TPCC is the operating income. And if you look at the formula, it refers to the income statement AG19, which is coming straight from the income statement, and likewise for the other years down here. So we start out with the operating income in this case, but depending on your business reasons, you might want to go with the net income, or you might want to do operating income. You'll have to sort of figure that out on your own. So once we've got that at the very top, then we move into adjustments from operating activities, investing activities, and financing activities. So the first thing we move into is adjustments from operations. Now what you'll see here is increase or decrease in the accounts receivable for 2011. So if you look at this here, and I'll click the F2 so you can see the formula more clearly, it refers me back to the balance sheet, and it says K9 minus L9 on the balance sheet. So if I go to my balance sheet tab and I look at K9, which is the accounts receivable balance for December 2010, and L9 is the AR balance for 2011. Now, if you look at those two numbers, the AR has gone from 3.7 million down to 3.5 million. Now, accounts receivable is when someone is supposed to give you money. So the fact that the AR balance has gone down from 3.7 to 3.5 is a good thing, because what that means is that cash came into the company, which is why the balance went down. So we should see a positive number on the statement of cash flows, and there it is, the difference of 273,058. The next line, coal inventory. Again, this refers us back to the balance sheet K12 minus L12. So if we go to K12 minus L12, again, notice what's happening here. As of December 2010, the inventory is 697.9 thousand, and then the inventory drops to 588.26. So the thing is, when you have inventory dropping, that essentially means that someone's buying that inventory for you, and that means cash is coming into the company. So again, you'll see here that it's a positive amount. Now, the next line is increase or decrease in prepaids. So this refers us again to the balance sheet K16 minus L16. So the prepaid asset was essentially money that TPCC had forked out for certain services and goods that it wanted. So the balance stood at 1.26 million. But as of December 2011, the balance had gone up to 1.379 million. Now, anytime there's an increase in a prepaid asset, that means that you are forking cash out of the company. And so if we go back to the statement of cash flows, we should see a negative number, which is what you have there, the negative 116,250. That means the impact from a cash flow perspective was negative. Next, let's look at the accounts payable, L30 minus K30. That's down here. So if you look at L30 minus K30, what you have in K is 2.298 million, and the accounts payable is rising to 2.51 million. Now, accounts payable is money that we have to pay out to our suppliers and our contractors. And the fact that this balance is going up essentially means that we've been holding off on paying that cash out, even though we may have recognized it as an expense on the income statement. So this should be a cash adder to our cash flow. And there you see a plus 211505, which is exactly what it is. Likewise for accrued liabilities, I think you get the idea now. Now let's look at depreciation. It says K24 minus L24 on the balance sheet. Now, K and L24 are accumulated depreciation. So what we are seeing here is that the number essentially rises from 352.952 thousands to 388,248. What this is basically saying is that you have more depreciation than you did last year. Chances are you probably bought more equipment or some such. But the fact is that the depreciation expense has been added on for the year. And so depreciation, as you know, is a cashback. So we see a cashback here of 35,000. Depletion essentially follows the very same concept as depreciation. And then this is just simple math where we're adding up all of the operating adjustments to get our net cash from operations. Next, we move on to adjustments from investing activities. And I am going to skip over places where we don't have data or where the data is zero. And now let's look at increase or decrease in parts inventory. So it says balance sheet K13 minus L13. K13 minus L13. What's happening there is that your inventory as an asset is going from 95.6 to 104.4. Anytime you grow your inventory, that means that you're not, either you're spending more money on building that inventory, or your inventory is not moving quick enough. So anytime that inventory number goes up, it should actually reflect as a negative on your cash. So there you see it's a negative on the cash. Now on the land, again refers us back to K17 and L17, $50,000. Now if you look at K and L17, and more importantly, if you remember that we had an assumption that this is going to be increased at $50,000 per year. So what that means is that $50,000 was actually spent by us, which is cash out of the company. Increase or decrease in machinery and equipment, K19, L19 on the balance sheet. That's right here. Now the machinery has gone from 10.4 million to 11.4 million. So very easily eyeballing this, what this tells us is that roughly about $1 million has been expended on purchasing new machinery, and that likely means that cash that's gone out of the company. So that's negative 964.401 is the money that was spent on buying new machinery and equipment. And likewise, transportation and equipment, don't need to go into the details. Now, from a financing activities perspective, what it shows is that the loans from affiliates goes up by 126.8 thousand. And if you look at it, it's balance sheet L31 minus K31. So if we go to L31 minus K31, what you see is that the payable to affiliates goes up from 1.379 to 1.506 million. Anytime a payable goes up, that means we did not pay cash out and we hung on to our cash. That means that's a positive impact on our cash flow, which is why you have the positive 126. And so you get the net cash from financing and then you add it all up and you have your total change in cash. You have cash at the beginning of the period, and if you look at the formula, cash at the beginning of the period plus changes in cash during the period gives you the cash at the end of the period. Now the other thing I want you to notice on this sheet is that this 264,99057 essentially rolls up and becomes cash at the beginning of the period for the following year. Likewise, the 46551 rolls up, and if you look at the formula, it just directly refers to the cash at the end of one period is the cash at the beginning of one period. So when you do your formulas, this is something that you should keep in mind. And now here, what we just have is a quick check on the calculations and whether the cash and cash equivalents match the balance sheet. And the true here basically tells me that my income statement meshes well with my balance sheet, which meshes well with my statement of cash flow, and we have a balanced set of financial statements. So on that note, we will stop here. Hopefully this gives you a sense of projections for the income statement, the balance sheet, and now the cash flow. Thank you.